Hey everyone, welcome back to the channel. Today we're diving into one of the hottest and honestly most under-the-radar energy stories happening right now, LNG. That's right, liquefied natural gas. It's booming, it's geopolitical, and if you're an investor, it's something you really want to understand. So grab a coffee, let's break it down. So here's the big picture. The LNG market is going through some serious shifts. Not just because of supply and demand, but because of politics, war, infrastructure, and even climate goals. It's not just about gas anymore. It's about how countries balance energy security, price stability, and long-term strategy, all at once. Let's start in Europe. Everyone remembers how Russia used to be Europe's biggest natural gas supplier. But since the war started in Ukraine, those flows have dried up. There's been talk about restarting some of the pipelines, like the one through Ukraine's Sudzha transit route. That was one of the few channels still technically open after the war began. Now, even a partial return of Russian gas through Ukraine, we're talking like 40 to 80 million cubic meters a day, was seen as possible. But full pre-war volumes? Not likely. One of the key pipelines, Sokranivka, has been out of commission since 2022. And politically, restarting Nord Stream 2 or the Poland route is just a no-go. And here's the thing. Even that partial Ukraine route is now in question. Why? Because there was damage to a metering station on the Sudzha line. Not good. Plus, Russian officials made some comments that raised even more doubts. One basically said, "We'll only fix the pipeline if we get new long-term gas contracts with Europe." Sounds like a bargaining chip, right? The truth is, Russia wants more than just quick cash from spot gas sales. They want leverage and long-term deals. But here's the twist. European buyers? They're not biting. Not back in 2021 and definitely not now. Even if industrial buyers would take cheaper gas, nobody wants to be the one signing a deal with Moscow right now. So Europe's not exactly rushing to bring Russian gas back, even though it would dramatically cut energy bills, help industry, and support stronger growth. And that opens the door wider for one big winner, US LNG. Let's switch gears and talk about the US LNG exports are exploding. And I mean that in the best way possible. One of the biggest drivers right now? A facility called Plaquemines, run by Venture Global. It's ramping up way faster than expected. They're already producing above their original nameplate capacity, and feed gas demand is projected to jump from under 1 BCF day to over 3 by the end of this year. That's a huge leap. Add that to other players like Corpus Christi, and we're looking at summer 2025 LNG exports jumping over 3.5 BCF day year on year. It's a monster export story, and it's only getting started. But LNG isn't the only growth driver for natural gas. We're also seeing stronger than expected power demand in the US. Yeah, even with more renewables, gas still plays a massive role, especially during peak demand seasons like hot summers or cold snaps. Now, on the supply side, the Haynesville shale basin, which is a major dry gas production hub, is stepping up. Production there has been beating expectations, and with gas prices recently moving above $4 per MMBTU, producers are getting motivated again. Drilling is expected to ramp up in late 2025 and into 2026, especially if prices hold above $4.50s. That's the sweet spot producers have mentioned as the trigger for significant investment. And this time around, they're not competing with oil drillers for equipment like they were back in 2022, so they can move faster. That said, most of the near-term production growth is actually coming from already drilled but uncompleted wells, the DUC inventory. Think of it like tapping into a reserve tank. It gives a short-term boost, but you can't rely on it forever. Meanwhile, Permian Basin gas, which is produced alongside oil, is expected to slow down. Lower oil prices are capping growth, and by 2026, we could see bottlenecks that limit gas output from the region. What does all this mean for prices? Well, even with tighter supply and booming demand, US storage levels still look pretty healthy through the next winter. That's keeping a lid on near-term price spikes. But 2026? That's where things get interesting. By late 2025, if drilling doesn't ramp up fast enough, we could be looking at a really tight market going into the 2026 to 27 winter. That's why analysts are raising their price forecasts, some calling for $4.50 or even higher through 2026. And if Russia somehow re-enters the market, that adds even more uncertainty, both for Europe and US LNG exporters who are counting on global demand. From an investment standpoint, here's what matters. First, infrastructure plays are big. Think LNG exporters, pipeline companies, and even service providers that support the build-out. Second, pay attention to producers in basins like Haynesville, the ones that benefit directly when prices rise and LNG demand stays hot. And don't sleep on the volatility. Prices might swing above forecast levels, not because of immediate supply shocks, but because the market starts pricing in tighter conditions 1 or 2 years ahead. So yeah, the LNG market might seem quiet on the surface, but underneath it's moving fast. And if you're an investor, this is a space where you want to be early, not late. All right, that's the deep dive for today. If you found this helpful, smash that like button, drop a comment with your thoughts on LNG or gas prices, and don't forget to subscribe for more market breakdowns just like this. See you in the next one.